It's the Market Sniper. Yes, we're here with you. And as we've been saying for a long time, this is a great turning in the debt market. Debt is no longer an instrument to be touched, and markets are dumping it. Yields are utterly running, and you are looking right here, right now, the Italy 10-year yield after failed talks with the EU about budgets. Italy has been one of the most unhappy with the euro situation, totally covered and smothered in debt, and one of the most in need to just put up and shut up with German Francophile designs. They are considered the most skeptic of the Euroland project after Britain that left. And we drew this and we shared this in our community a number of days. It was a couple of weeks ago, highlighting a double bottom and a little squeeze here, and that we felt the yields were going to be moving somewhat on Italy. Isn't that interesting? In the time since that HVF draw, particularly in the last 4 days, we have had an utter moon in Italy from 3% to 4.273. It's moving in front of my eyes as I'm doing this. I stopped doing a whiteboard explanation of debt and video on how we will have a super spike in rates, which will lead to a super spike in dollar, crushing the Asian currencies, particularly the Western friendly, not those with gold as near as much like the Chinese yuan, not those with gold and oil like the ruble, which is almost the now pristine quality currency of the world system. No, but crushing all the FX emergings, all those over-indebted, super spike on the Italian lira, etc., 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 etc. All the FX emergings, and Euroland will also be part, but first the Asians. And of course our super spike candidate, that was my 2019 Bitcoin long, Bitcoin against the Korean won, the USD Korean won. So Asian markets collapse, FX markets collapse, all on a tightening of the Fed on US debt that is running away and the rates are climbing, a loss of value in that debt, and what it actually means for you long term. Because so many questions that I get show that people conceptually don't have the full understanding, and I'm going to try to answer that. But first I wanted to show you the Italian debt, because this is the hottest, fastest mover right now, and it is devaluing. Inverse relationship. What you have to pay in interest is because your capital value is going down, inverse relationship. That means less demand. You have to offer more yield for people to hold it. They're prepared to pay less. They want a bigger yield. And we'll come to a lot of those dynamics in debt. But let's just run the gambit on the debt markets. That is Italy. But it ain't that great in the American market. We have been warning that the debt cycle turned in 2020. We have done this and shown this chart so many times. It's broken record season. The debt market is in fail. Every time we hear, buy bonds, wear diamonds, we have said, don't buy bonds. You will not wear diamonds. Diamonds aren't worth that much anyway. They pull them out of the ground everywhere. But you won't wear gold or Bitcoin or anything else if you buy bonds. We highlighted countless times, and this will be super short because you've seen it all before if you're regular watchers, that was super stimulatory conditions that came out of this inverted structure over there, and it has lain down a funnel, and we expected this funnel to be broken, which will indicate that debt is in a parabolic move up on yields, down in value, which will trickle through, spoiling derivatives, banks. Money is borrowed into existence with debt. We will show you that now on the whiteboard. This is the US market. This is why we call, be big and heavy and long cash. Be in gold and silver, physical held. There is a major crash in the debt markets. This is a proper risk off environment. You have hyper stagflation, extremely high inflation with recessional going into depressional growth. That means the interest rate policies of reining back inflations will utterly kill and deflate asset prices that have mega pumped after 7 trillion was put into them in the last crisis, which was the COVID crisis, which well exceeded all the quantitative easing that went into the great financial crisis lows of 09, 10, 11, 12, 13, 14, 15, multiple QEs 1, 2, 3, and 4. They were absolutely tiny in comparison to what went into the market on the COVID-19 March 2020 event. And this is, my friends, the creation of money and the creation of a huge amount of new debt. Most of it badly done, sent to the Kennedy Institute, the transgender quango, this, that, and ever. Ill-gotten, non-value creating money. This is Reinhardt and Rogoff as you come to the end of the GDP to debt relationship. Once you're past 90, most dollars borrowed into existence generate much less than $1 in GDP. That means you are standing on the street corner selling $100 bills for $20. It's a bad business. It goes wrong. It accelerates the decline. Things are going to come at you faster than you think. Things are going to come at you faster than you think. This is America, the currency that is holding up best because all the others are releasing the value of the currency. Japan's solution is to maintain garbage interest rates on their debt. That's right, utterly low and low. How? By printing up money and holding up the debt market by becoming a bid. It's time to show you what I've started to do with debt. And I wanted to explain how when you take a loan, you, Mr. Joe Soap, you borrow from a bank, you then get some cash. That cash is an asset. You go buy a house. That house is an asset. But you also have a liability to the bank. You have a liability to the bank that gave you the loan. On the bank side, you are their asset because you are now owing them something. That is how it works. So you are now an asset on a bank's balance sheet to that bank because they hold value in you. But they ask for tertiary extraction out of you. So you have to do something super productive that you not only pay that money, but you pay additional back money. The very first dollar borrowed into existence, and it wasn't just one, but let's just pretend it was. You borrowed $1 and it was an asset for the person, and then the lender that lent it out got to charge the other person tertiary on it. That is why tertiary is banned in the faith of Islam. And the only time that Jesus got violent was in the synagogue with the money lenders, because it is a shell game that always ends badly. All fiat systems end because of tertiary extracting. It requires ever greater supply of money, which is a net inflationary scam, because the interest on that initial $1 you borrowed into existence also has to be printed so that the person can earn it by doing some work, rendering, to pay back the original $1 plus interest payments. So you have an ever expanding need for the money to be proliferated until such a time as the debt is so large that is being used in creating it. The productivity that it's done has got so low because you've flooded the world with money, and now spurious things are getting money that should never get money. And assets inflation is the first part of the inflation, and you moon all the assets, ergo the property prices. And as a result, you then subsequently start to see debt disappear, the yield required needing to go up. This is what we're experiencing. So all money is borrowed into existence. T accounting, assets and liabilities. So when money dies and you can't pay your credit card and you declare bankruptcy, that asset on the bank suddenly is broken and written off, and their balance sheet is reduced. They no longer have that asset. You go to the bankruptcy courts, they can't hassle you. You say, I don't have it. They give you a bad credit score, all of that. That asset disappears. Money has collapsed. That owing and that obligation is gone. That which you spent on whatever physical items, the bank will try claim back any value, and they'll take anything of value and sell it in lieu of debts. But after you've finished that bankruptcy proceedings and you're a man of straw, you essentially still have your life, but the bank has lost that asset. Now they need to have made money on performing loans, paying interest to make whole that which they lost. Otherwise, their balance sheet is destroyed. And what is happening? You bought a house. That house has been going up in value. And now all of a sudden, interest rates are spiking and you need to refi in 1 month's time. And the payment you used to be able to afford is now going to be done, instead of at 0.33% at the low on the 10-year, it's now going to come in at 3.5%. That means it's going to be 10 times the cost. As a result, you can't refinance it. You can't pay off the loan. You're a forced seller, but lots of other people are forced sellers. So now there's a glut. So the pricing gets lower. You eat a loss. You still owe the bank even after you've sold. You now have to pay it off. And now the interest rate on that loan is much, much higher than it ever was. This is how assets shrink when money dies. Money dies when debt loses value. You are watching a debt-based system contracting in value. The ability and the belief and the confidence in it to continue has failed, because we showed you the chart that represented the final capitulation of debt. We showed that to you over here, back to the charts, when we showed you the long-term cycle where interest rates were pushed super high during the Volcker era way back then. And now you have truly turned. Let me just be clear on the highs that you have taken out by running that funnel. These were the Volcker era highs. This takes you right back to the 80s. What happened in that period? Prior to that, you had a huge run in gold and silver on currency debasement. Nixon and 71, following the costs of the Vietnam War, had removed gold. Over that decade of the 70s, everyone in Europe asked for their gold back rather than taking the dollars. In America, you had a major run on your gold going up in value and being taken back from America, and on fiat being printed by the faith-based system that Kissinger brought in with the Vietnam War, the great warmonger, the great war criminal that he be. So what do you do now? You have taken out that high, you have taken out that high, and my friends, you will take out all these highs in time. But what may end up happening before some of these later ones could have a chance of risking is we will have a systemic failure. Why? Because there's too much money that all have interest payments due at higher interest rates that are no longer affordable. All that load up occurred at rates that were super low. There was your 0.3% over there. These numbers are all relating to these lines I've drawn over here. This was 0.3. Now you're at 3.452, running for 3.5%. Also, what happened? So much I'd planned to write up on this strategy, this little whiteboard, and do this whole thing. I'm not going to finish it now because I'm preempting it. But what happened is governments are the biggest borrowers. They birth money through bonds and T-bills. These are your Italian T-bill that I was showing you, American. Golden schmucks are primary dealers, and they get these from the government, and they have a license to sell this on. They are one example of a schmuck bank that does that, and they sell it to the dumb money such as pension funds, and your payroll deductions have been buying that garbage. Normally, in the economics of supply and demand, the greater the price, the less quantity is demanded. That's your demand curve there in the gold. The higher the price, the less common it is. So, for example, there's less Rolexes than there are Seikos, and there's less Richard Milles than there are Rolexes in the watch world. But the price goes up, the volume that you can sell typically goes down. That's your demand curve. People, in terms of interesting supply, the balance is actually, for most products, where the demand curve is equaling the supply curve. So at that price, you are in a balanced market. What the whole point I'm making here in terms of debt is the supply has never stopped growing in debt. New debt is being created all the time, and the old debt doesn't die. It sits around wanting interest payments. That means it requires money just to maintain it. You have to pay interest payments on the old debt, and now that interest payment is escalating at an unbelievable rate in a failing debt system that very few people have even realized has turned, that we told you in 2020 in August had turned, and that you are likely to see the major reversal, that head and shoulders on the TLT. How many times have we done a chart with that recently, and even further back when we were initially talking about it in our premium community? Go to themarketsniper.com. We are reading the market accurately. We keep on keeping on when we do it. Have we been inaccurate? Yes. Can we be inaccurate again? Yes. Is it an on-balance or probability assessment? Yes, but you cannot stop a snowball once it's running down a hill. And there's some people that don't even realize that you're having a debt crisis. This is a debt crisis created by stimulus. And the inflation has been created by proliferation of money. And they will tell you it's your neighbor that bought all the toilet rolls that caused the prices to go up. And your other neighbor will be told it's you because you bought solar panels, and that took a lot of silver out the system, and it took a lot of manufacturing, and China had to buy a whole bunch of stuff. Everything you do, we will be told it's you because you hoarded. It's you because you did this. It is a central banking cartel policy of inflation. It is their inherent policy. Greenspan brought it in and he inflated the assets. Nobody complained because they were making money, but the billionaires were making the most money who had borrowed the cheapest. It's an enrichment tool for the billionaires, and the dump is an impoverishing tool for the middle and working classes, because you get sold out at the bottom and they will buy it off you, as they will buy your houses that you won't be able to afford because your mortgage is no longer payable, because they've done a major pump in the yield rates. The whole world is going to experience the George Soros failure of the Bank of England experience, only we're going to have a macro version of it. You're going to be thrown out of your house and turned into a tenant, and BlackRock, Vanguard, and all the other Amazon's now a land buyer. Isn't that interesting? Another oligarchical corporation enters the fray, buying up your properties to lease it back to you in future central bank digital tokens when that all comes. Debt doesn't die. They require interest payment and maintenance being paid on it. All the time new debt is added. If you only cover your expenses on 52% of your tax take, that means you're borrowing into existence 48% new money all the time on an ongoing basis, and forever giving to the golden schmucks primary dealers scammy debt that has to be pushed into largely hedge funds that want to trade it, hold it, pension funds, the dumb money, particularly this late in the cycle. And guess who holds the dumb assets that will go to zero? You. But you'll be told, don't worry, we'll make you whole. You can have a UBI, providing you fulfill the following conditions. Your medical records are up to date. You've taken all your boosters. You've taken a chip in the brain so we can check and make sure that all you're very healthy and up to date, so that you can travel, so that you can yada yada, and you don't eat too much meat, and you have a locust burger every now and then instead, until it becomes the mainstream of your meals. That is where we are going. What has also happened just while we got the supply and demand? Why did China do lockdowns and hold? Because they want to hold pricing power. If this is the price of widget X at the moment, but demand is now being killed, so we go into, say, a yellow line here and illustrate a new demand curve because the consumer is being killed, that runs something like that. At that price, only that would be paid as price. Sorry, at that same volume, only that amount would be sold and the price would be lower. Can you see that? Price on the new demand curve, demand 2. This is basic, very early doors economics. Demand 2, that would become price 2, and the amount demanded 2, and supplied, quantity 2. Well, guess what? China doesn't want their pricing power to go down. So what have they done? Well, they say, as long as you're killing the US consumer, we're going to reduce supply. So the supply reduces and you end up with supply chain 2. So you get, must lockdown cause COVID. Lots of useful excuses. You've gone and done reduction on your demand curve like that. Well, that is demand failing in that direction, supply going in that direction. If you want to purchase, you will have to purchase from us at a much higher rate. In fact, I've done the supply curve on the wrong side. The supply curve will move to the left to chase the demand. So the supply curve will come here. Let's do it in blue because I'm really confusing you now. So the new supply curve will come like that. So as the demand has moved away, the supply chain will in fact move with it. But the total amount bought will be a whole bunch less. You see, the price is still the same, but the quantity purchased is a bunch less because they're closing supply. So they will retain, the Chinese will retain their pricing power by changing their supply curve. COVID, we're going to reduce less. We'll just stop producing for a while. Match the reduced demand with a significantly reduced supply, and you retain pricing power, still all at the same level. However, the amount provided is now quantity 2 instead of quantity 1, there is a much smaller economy in play. Only the rich wear Rolexes and Miles, no longer the middle class. Only the rich even have Seikos no longer, or the middle class only have Seikos, because it's become expensive and it's a discretionary purchase. Same for TV, same for everything else. Now, that little aside I threw in just to explain why we always seem to have COVID tests, monkeypox tests, just as we're getting terrible news on inflation and the yields are pumping and the US consumer is being killed. The US consumer is the primary provider of dollars. Here is God almighty USA with Mexico below and little old Florida up top there and a teeny bit of Alaska and Hawaii. Let's be totally eccentric. And here is yellow China. Let's choose a little bit of a different China. It's a bit like a kidney bean like that. And then beating up a few Tibetans somewhere over here. And then you have Seoul and North and South Korea over there, and you have Japan. So the Triffin's dilemma is the key aspect and attribute where dollars are being provided by Americans to Red China. We send over dollars, says he, and that is what you send over here. So dollars are going, that's Triffin's dilemma, and China sends back in return to you goods, real goods. Samsung TVs come from Korea. Apple phones come from China. You have a Toyota or two. We can put in Japan in there as well. Little islands that are not well loved, Western friendly for now, surrounded by their friends. Here we go. There's little Japan, little island, little island, little island. And they send to you Toyotas for dollars as well. So that also comes from here. And this is the Triffin's dilemma. All of that comes and you send back dollars. Now, because the retail consumer is not buying nearly as much, and a lot of it is provided imports, these nation states are not getting the dollars that they need. And they buy oil, for example. If you're Japan, you have no oil. You have no direct commodities of any great scale. So that starts to be a problem. It pushes up your inflation. So the export of dollars is reduced and the purchase of goods is being reduced. Hence these illustrations that I've given you on the demand and supply. When we bring it back to debt, we've only seen debt values go higher as the supply ever gets bigger and bigger and bigger. And that, of course, is a complete Ponzi scheme because it is managed market where the rates have been worked low on a managed crisis basis. We have to drop the rates, so that they can continue to hold the valuation of that debt up. So much so that our friends in Japan are actually exercising yield curve control, where they are printing money, yield curve control, where they are printing money to buy their own debt. And as I showed you when we were looking for the Japanese debt, we never actually got there, let's go find it, that the Japanese debt is very, very low paying in terms of what you receive. Why is that? Well, their problem is, see their yield, it's gone up to 1.23%. It's not very good. It's a lot lower than the rest of the nations. And that's still with government buying it. Why are they buying it? Well, they're buying it because they don't want their citizens, who are all pensioners mainly, because they have an inverted pyramid for a demographic structure, not to be able to retire. Old people vote, and not to be able to get grumpy because their pensions are going down in value. And the consumer in Japan bought its own government's debt, particularly. The Japanese consumer bought its own government's debt. Now it's the government's responsibility to keep it up. They have 279%. If we just do that, Japan, or debt visualized by country, debt visualized by country. You can see how big Japan is. That's not the one I was looking for, but you can see how big Japan is for its small nation state. you can see exactly how big it is. Let's say goodbye to those country jaws. And that is a big problem. China also got super big, but China has gold, 238%. This is the relative size. Cyprus, terrible. Spain, terrible. Europe, generally terrible. US, terrible, not including unfunded liabilities, which would put it at 600%. But for now, they're an exception, and they are strong because they have the global currency of the world. Italy, 132%. One of the worst of the Portuguese nations. One of the worst of the Portuguese nations, the European nations. Apart from Greece and Cyprus, one of the worst. Spain is very bad with it. So these debt situations are exceedingly tenuous, and these are the worst. These are the worst right here. Let's have a look where our friends in China. It's not included on here, although the other diagram did include them. So what is this? What does this mean? Well, these guys are most desperate to keep their values up, because their pension system will fail. Their elderly voting parties will fail. So they are destroying the yen, printing lots of yen to keep holding it up. It's unsustainable. Their yield is still going up in spite of that, just less so. So you have the most yield, yet you're the highest value and paying the lowest yield. You have the most debt. So the more supply you have, it's unbelievable. The price should get cheaper as per the supply and demand, but this one is the most valuable because it's only paying 1.2% yield, and that's kept the value up. It's kept the value up. If you show the value, that's the value of the 10-year. You can see it's selling off a little bit, but there is buying to keep it up. This is buying to keep it up. It's a monthly chart. We can go to the weekly. They are buying the damn dip on something that is skidding down. Too much debt in the system. So more supply, it should be lower demand and lower price. But in the debt system, it's been totally reversed. And they've used that debt system to hold up the debt and hypervalue debt and suppress gold and silver. So whenever you hold one thing down, you have to hold another thing up. And whenever you hold one thing up, you have to suppress something that will highlight the loss of value in true money. Something that is physical, that cannot be controlled. Hence the paper price. Hence why gold and silver trades up over the Asian session generally. And if you look at the chart of just the Asian session, you have a moon. And if you look at the chart of the UK to the US session, you have actually something that is in a state of capitulation. But that is why you have the general upside, because it climbs even more on the Asian session than it sells off in the US session. Why does that happen? Because they are suppressing the price. Neither market is true price discovery. They are distorted markets to hide and extend the situation. And they will tell you that inflation is low. It's far higher than you realize. It is a runaway thing. As the people start to realize it, more and more people will bring forward expenditure. So people's pattern of behavior, this is what everybody misses. Oh, we got peak inflation. No, not now that people, as soon as they make the money, they rather get something they know they need in advance, early and fast, because it's going to cost 20% more in 6 months' time, a year's time. People will stockpile. They'll stockpile even things that don't save well, like food. They'll buy freezers. They will stockpile diesel and oil. That's going to further exacerbate the supply chain, further push up prices. And you get a destabilizing effect, exactly like we got in oil when the America became independent on fracking, and then all the others printed more oil. They didn't print it, they pumped it, you know that. And as a result, they caused a glut, and then they needed the same amount of income, so they had to do more. As the price went down, they had to do even more. Markets are inherently unstable. When you lose that balancing force, they capitulate to the downside or they melt up. There are nobody sensible that should be wanting to hold debt. Debt is likely to go to zero. There is an absolute fortune of it. This is the collapsing of money. The banking system will fail because the banking system is based on borrowing a dollar into existence. Every part of debt, including your little home loans, can be parceled into collateralized debt obligations, much like you remember in the subprime, everybody's mortgage. But when you pile a lot of crap in there that isn't going to get paid, you end up with toxic debt that's supposed to be high yield, doesn't get paid. Talking of high yield, last time the Fed stood behind the high yield chart. And that is the worst quality debt that can borrow but at much higher rates because they represent high risk. What's been going on there? Well, let's have a look. Spiller thriller, all the way from Manila. Last time they stood behind it at this point. We've done this chart with you before. The debt markets are failing. You should care about debt markets, even though you don't understand them, because everything that you use is based on it. Everything that you use is based on the principle on debt markets. This guy is now giving me crap. Doesn't want me to look at it on a 2-week time frame. So there we go. Intervened, boom, up and over, spiller thriller, all the way from Manila. This can go a whole bunch lower. We had an inverted HVF target for 49 and a lot more. Let me tell you, big corporations that are heavily indebted, that are garbage corporations, such as General Electric, IBM, all are super indebted, and they should be junk rated. They are one level in many instances to junk rated. This will affect equities. You are going to see an asset market capitulation for as long as this is allowed to continue, and it's very hard to stop. Further proliferation and creating money to support it is going to cause a huge whiplash boom in anything that can't be printed, such as physical assets. And they have decided until they kill inflation, they're not going to do it. This is what's happening. So the junk debt can't be supported at the same level in the same way as the previous time. This is a beautiful inverted HVF. Go to themarketsniper.com to find out why we traded it the first time and why we're trading it again. This is going to go down in value. This is the big short all over again. Most assets down in value. And then you will get the the inflationary policies that will give the long. This is what I suspect will happen. As last time, it was QEs were 100 billion here, 150 billion, and a couple of 100 billion. That was in the great financial crisis, quantitative easing, and they did a number. Then eventually we had we didn't have any QE. We just had interest rate drops in the dot-com boom. So let's just have a look at a major indice. What happened during all of these periods on the major indices in terms of all of this? On the major indices, during the dot-com boom, you had a major run in obviously the NASDAQ, particularly, but you also had it in other indices. Let's get it up here. Let's have a look at our history. Let's have a look at our history. The NASDAQ is down, down, down. Here is your dot-com boom. We cut interest rates to all-time lows. Remember that? Crash, 2000 to 2001. America went into a recession. Greenspan himself, he cut interest rates. Then we got ready for the great financial crisis in property. At that time, we didn't have the highs. This was the first time we went into quantitative easing. Ever more expansionary, money destroying. So the price of money got cheap here. The price of money got cheap and we created new money through quantitative easing. Then we stumbled forth into the repo rate crisis, quickly brought in the COVID crisis of March 2020. Let's just hide some of those jaws. So we're looking at the history of indices and assets from an equity perspective now. This is an absolute spiller, guys. If you can't see, it's a spiller. I don't know what to say to you, and it can go a lot further than most people realize. It is an absolute spiller. So we look at this. So that was when we started for the first time printing money and destroying it, not just by the price we charged, but more. This was the repo rate crisis that then quickly led us to the cover and the 7 trillion pumpermentals. This is your major pumpermental 7 trillion benefit in market cap. Trillions were made, momentum stocks, entire Robin Hood realms started to emerge. This is the beginning of your correction that is part the way in. You can round trip right down to the COVID, you can have a small bounce and you can go lower still. The assets are hyper valued. The current GDP and the market cap of the stock market to the current GDP is still way beyond all-time highs. It only recently passed the GDP that existed around the dot-com era. The extension of the percentage how much market caps of equity is to the gross domestic product of the country. And it was the highest point it had ever been, that chart. I've shown it previously. I don't have it to hand here. You're still just getting back to those levels. So in valuation highs, you are here. in terms of percentage market cap to gross domestic product. Plus, you are having a collapsing debt market, which means money is dying. This is going to be very, very dangerous for the banking system. Very dangerous for the banking system in all ways. It is going to be very dangerous in the banking system. So the NASDAQ, the Chinese, by the way, Chinese NASDAQ collapse. Look at that. Complete roundhouse return right the way to 2018 levels. 2018 levels. What would happen to America if it returned to 2018 levels? Down 6,000 you could fall. What do you think will happen to ARK, Cathy Wood, speculative investments? Terrible, terrible, terrible. We are short. We are talking our book. We are absolutely talking our book. It is spilling 36.94. You are looking what the NASDAQ could look like in time. When the kings, the cash generating kings, are in proper capitulation and have given back the major fundamentals of the March 2020 events and are back down at these levels, then you might start thinking that the beginning of an asset valuation is part way done. Not necessarily concluded, but part way done. Then there's Tesla. This is a boomer mental, absolute insanity from October $1949 to $658. By far worth more than every other car company. Good luck selling $75,000 battery cars to a crushed consumer. Good luck indeed. This is not a good time for assets that are hypervalued, and just about all of them are. The only way they bring, by the way, inflation, the biggest driver of inflation is invariably the energy complex, particularly oil. Oh, oil's doing just dandy. We predicted the crash in oil and we predicted the subsequent turn and run. The spiller, this absolute thriller all the way from Manila. We were there, we were short, we took you to single digits. We told you it is a much higher likely probability that you will see single digits than anyone has baked into it. That YouTube is on our channel. You will see a level of price you haven't seen in oil since the 70s. And you ran on this particular chart, you don't even have enough data. You ran literally to zero. You ran all below the pricing of the 80s, all sub $10, single digit oil happened. And it was called here. And we have told you that this is now the strongest asset category at the moment. Oil is strong. Even in, and to kill this oil price, they'd need to get it right back down to 70. Think about something so strong that capitulated so hard to the downside. We said warning, when you have the absolute capitulation to the downside, the bigger and the harder it is, the bigger and the harder the pump that will come on the other side of it. And the bigger the harder the pump, the bigger and the harder the dump on the side of it. And you can see this yourself right here. And that is what gave us the macro reasons. This is why I say we're the only macro technical. We're not the best, we're the only. Nobody else is seeing macro pumps and dumps and calling them and pointing out the logical inference that comes next. Geometrically, HVF method is a geometric understanding of volatility and scaling, because the same participants that are feeling the pain will be participating. Most of them are institutional in the pump. And this is the nature of our markets. And it doesn't have to be exactly to a cent accurate. It is broadly accurate, and it is bringing you out at unbelievable targets. There are people that are warning that you should get ready, get ready, get ready. Here are news, by the way, all banks in Shanghai. 9th of 2022, preventing withdrawals, my friend. They will bail in right the way through everything you own. If you don't own gold, silver, oil, and other asset categories that will see you survive. I can tell you something else. There was this tweet that was of great interest to me. I work in a dev at a popular gas station. We had a change request come through. Update gas services. This is not normal petrol in American terms, it's gas, natural gas, to support double-digit prices. That's what's happening. Natural gas is at 7, it could go higher. It's been more responsive to this sudden pop in yields. It sells off. Oil is the strongest. Oil is the strongest, but you're getting a little bit of pushback there now. But it has been in a runaway market for the last period. There's its first hard sell. It will do one of these, and then it will be back on the gravy train when they pivot. What's happening on your US indices? Spiller, thriller, it's falling. It's an absolute faller. And that is an awful candle because it attempted to rally, getting smacked, making new low. That's on the biggest 30 companies, guys. That's your SPY. This is your NASDAQ. They are tenuously holding on. They are tenuously holding on. Remember, there's a plunge protection team. That's true. It's true. It's not even a rumor. It's absolutely true. So taking you back to the whiteboard, debt doesn't die. It's still there. The only way it dies is someone goes bankrupt and doesn't pay it and it's written off, or you settle it in full. Then money dies. When you pay off your overdraft, you're taking that money, you're putting it back in the system, you're closing a loan, that money folds away and it's gone. You don't have it, the bank doesn't have the asset anymore. When the opposite is happening and they're proliferating, there are assets growing in the bank's balance sheet and there are liabilities growing in consumers' balance sheet. When they can't pay or they don't pay or it gets too expensive to pay because of yield, all that money crumples in. You're watching a system in failure. Do not be overexposed to the banks. Do not be overexposed to the banks. There is real drama and crisis coming, and people will start doing panic buying because prices are out of control, and the oil price has stayed up despite assets correcting violently to the downside. You are watching this unfold, and what's happening on the currency markets. This is what happened on your USD JPY, and we've done a lot on the ruble. That Dixie is absolutely mooning. So let me be clear about this. The dollar is going into a super spike on debt related yields. This is the ETF. Shares for 20-year treasury bonds falling down in value. The dollar is inverted to that. The dollar is related to the yield. We'll bring up the debt yield again for you to see. There's the US 10-year. This is two charts cut from the same cloth. Had to listen to somebody telling me how the yield on the 10-year is determining the oil price. These two are similar. These two are similar. These two are absolutely very close to correlated. The higher the yield, we've been warning, the higher the yield, this 3% break is going to be huge. The higher the yield moves up, the higher the dollar moves up. It's differential of interest rates that it's paying. You can sit and earn 1% in a depreciating yen, or you can hold a dollar and get going on 3.5%. Which one's going to happen? What are corporate treasuries going to do? They're going to flood to the big boss that everybody needs still to buy items. The dollar is going to have a super spike. That's not an endorsement of the dollar. In the end, it'll be the most indebted. It is how you destroy the Asian currencies. We've given you the USD Korean won chart countless times as to why this is going to be doing it. You should be here. Reset is on hand, guys. It is happening. It is happening. This is severe and intense. This is going to get very, very ugly for a lot of people. You have not seen the asset devaluation that is required at any level yet. Bottom callers are morons. There is no desperation yet. This is the macro USD Korean won. Let's put it on here. When TradingView wants to talk to me again, let's take it off and go back to the one. Did you see? Climbing yields is climbing dollar. Climbing yields is climbing dollar. Calling the end of the debt-based system and the rising of yields is a pump for the dollar. First, at the expense of every other relative fiat. I seem to have an issue now. You bastard. Let's go try one of the other ones. USD Korean won, please. So this macro that we've given you on the one that is absolutely huge is marching up with dollar strength. We've shown this chart countless times. I wish we could get it on here. Let's see if we can try one more time. Oh, it is South Korean one. It did it. I don't know what I was complaining about. It looks so like the Treasury. I didn't know it had even gone up. It's even looking like the Treasury yield. I had clicked it on it and it was already there. It still looked like I was on the Treasury yield. It was so similar. You just saw me make a mistake. I thought the chart hadn't changed and that TradingView wasn't functioning. This is going to pass. This 1300 fall is going to pass a key level that will see a moon spike on the Korean won. This is a rounded bottom. We gave this trade. We've been talking about this trade since 2017 odd, from around here. These levels. In fact, I remember watching this chart as here, 2016. We've been talking about it. It was our 2019 Bitcoin Korea won was the trade on the big fundamentals of Bitcoin, but the one did not have its currency failure. It feigned and broke back down with the Treasury print of the COVID pandemic. Now the one half of that Bitcoin long that went with the first cup gold nugget moon. Now Bitcoin's going the other way. Bitcoin and cryptos are high beta risk on assets in a bad environment for all of these. The Korean won is about a moon, in our opinion, and it will move violently and suddenly. And I was amazed. I just was amazed how it looked exactly like the 3-year treasury that I didn't even understand. This is all about dollar strength on a failing debt market. And the problem with when debt fails is every system that has debt within it is likely to fail unless it is bailed. The knock-on effects could be so vast. Your money in your bank is not safe. Cash on hand, gold, silver, held and owned and held in your name are the right asset categories. Gold and silver will still potentially go down initially. The dollar strength is not supportive for any asset that is priced in dollars, but watch what it is doing for the euro gold, the yen gold, and then when the dollar fails, you'll be left just with the gold and the silver. And that is going to turn out empirical in terms of everything. And the oil is not coming down. Everything else, asset-wise, is not coming down. Why? Because you had 2 years of lockdown and nobody doing anything for the supply chain. You went from a few hundred rigs, 300 and whatever it was, down to 4 that were offshore rigs in oil. They were all non-economic. They were all brought home. The people were all laid off. Good luck. 2 years of new investment didn't happen because of a pandemic that they did to create this exact very scenario. It's easy when you understand the game, how to make money. You position in the market for what next will run and you sit and wait. Currency, ruble, blow off ending to its all. It met our HVF targets. It's done. It's a blow off. Inverted HVF. It's going to get stronger to the dollar. It's going to be one of few countries that will. It's commodity backed. It has gold. It's not proliferated. You can't easily invest in it. Hey, we've divided the world in half. We're not talking to the other side apparently. This is the great game that is going on. But this currency is better backed than any other. In the longer run, I'd rather hold rubles, providing I could get access to them. The yen is going to be the weakest of weakest. It is not a sell at 136 when it runs our alerts. It is going to moon spike. It is set up against the Australian dollar, JPY. It's a setup against the Canadian, these commodity currencies as well. But the best setup is your dollar. This is the beginning. This first target is the beginning you're going to go. We got you back in on that falling wedge, a 3 impulse falling wedge. We told you about this setup way back when. This is a million miles an hour, trying to remind you of everything that we've said and done. This is a major breakout. It's about to make the first macro target. I will not be closing. Overperformance is coming our way. It's even in a setup for upside, for loss of value against the euro. The yen is weaker than the euro. I'm expecting the euro yen to absolutely pump, and that is not an endorsement of the euro or a site or an opinion of euro strength. We have structures where in time there will be such weakness of the yen that the euro will trade 164. This is another structure that we've highlighted that's been in our community. You're missing so much. You're missing so much. And by the way, there's a super macro blow off weakness in the yen that could see 200 on the euro. 200. You're hearing people say crazy numbers. Just like when I called TLT at 180 to trade 89. That is the debt on a head and shoulders, and everybody going, wow, that will never happen. The world will have ended. If this goes to 200, what do you think the USD JPY will be? What do you think the USD JPY? We're calling for a parity fail on euro to the USD. The euro is going to spill further to the euro USD, and the euro will spill to the Swiss franc in the end when the Swiss franc stop weakening their currency. It's back down very close to parity USD Swiss franc, you will see Euro Swiss franc also go down. The euro will fail, but first we start with the Asians. And you're at roughly 141, you're going 200. That is an unbelievable devaluation against an already flawed nation state like Euroland. This is what yield curve and debt will do to you. This is why it will be the hardest faller and the biggest faller. And the Japanese will have inflation like nobody else, but everyone will have it because it's fiat currency collapse. And in spite of all of this money being destroyed, the bulk of that loss is not going to kill inflation. It's going to be the assets that contract. So commodities that have not hyperinflated are not going to go down in price generally, apart from major reduced demand and people eating less. The fat is going to be cut off hyper-valued assets, debt, stock markets. The 60-40 portfolio that people told you the portfolio of time and Life of Immoral, Tony Robbins and everybody else, 60% equities, 40% bonds. When the equities aren't going up, the bonds are perfect balance. These are garbage. This is buy the dip for the 40-year pumpamental scheme that we've had. These assets are both overvalued and they are both going down. The Nasdaq down, the S&P down, all of them down, asset devaluation, and the bond market down with yields climbing. All of these things are going down. You won't be able to borrow for less than 10 to 12%, especially on fixed. Do you think your home is safe? If you haven't fixed it, you should fix it now. Do you think you're safe even if you fixed it for 30 years with debt? They'll renege, they'll bail in. I'm in a country where they took 47.5, basically 50% of everything over 100 grand and turned it into shitcoin bank shares that you now own. You were a forced buyer and became an owner of a bankrupt bank. Hey, we didn't steal it from you. You have something. You have shitcoin. Good luck. Good luck with your shitcoin when they take your hard-earned money and that every little element. That means you had 2 million in that account, you got 100 grand spared, 1.9, you lost half of it. How about that? How about that? Tough. You're an investor in a crap bank that's going nowhere, that's owned really by government, and you have no say, and nobody wants to buy it, and everybody wants to sell. Good luck. That is the nature of bail-in law that has been added to Australia, to Canada, to America, to everywhere. They did it here at a test pod. Oh, and it was also driven and designed to chase the Russians because too many Russians were depositing money in there. Oh, well, now they'll do it to you. You thought it was just about them bad guys that were dodging tax, those Russians, those dodgy oligarchs. Good luck. The same stuff is in for you. What you're happy about happening to others can happen to you. And this is what's happening. So the euro is even going to go up against the yen, the CAD yen, the Aussie yen. These are all insignificant moves to the upside. And that is not an endorsement of the Canadian dollar or the Australian. This is just how bad it's got to get for the Asians, which is why we will tell you the Korean one will have to join. Do you think the export advantage that you will get with in Japan is going to be allowed by the other westernized nations like Southern Korea? You're going to have problems in all your emergings, from India, from all of them. This is going to be a currency crisis brought about by a sovereign debt crisis, and they will say you did it because you bought too much stuff. You were a consumer society. You bought too much stuff. Meanwhile, they proliferated and printed everything that's going down. And you are watching it happen. You are watching their debt they created fail, and it's your fault. That's what they're going to tell you. And we need a more equitable society. We need a greener society. You will have to have your carbon check. You will have your CBDC. You must be healthy and not make others sick. It's time we recognize we're all in this together. We're going to build back better. We're going to be more equitable. More love for transgender people, people of color, people of everything but the white male bad. And it's time to recognize this is all coming for you in this beautiful, beautiful dystopia that is coming. And I laugh and I chuckle. The Korean market trading down. We did this. We highlighted this in our premium community, and I'm happy to share it with you as well. We highlighted this, that the Korean won and its ups and downs, it split that chart, were very, very contingent on the same aspects of equity devaluing, currency devaluing. This was how it looked. So let's go put that bottom one on the monthly. get that over to 2,000 over there. Get them under each other a little bit as well. Can you see every major move in the Korean won was associated? We've got 2 Korean wons on here. That's sexy. Let's get that Kospi back up there, can we? Thank you very much. So here's the big selling period in the Kospis, and this is why I'm calling a Kospi crash. Major Kospi crash. Here, down, down, down. Pumpamental Korean won. Flight capital in Korea. It is flight capital that will run. The investors in Samsung, many of them are American, many of them are other people. The collapse of 2008, rush into dollars. Collapse of the equity market. Then this little run up during the 2018 period into the top until America printed. Then America printed. Reinflate. Lots of it ended up in Korea, pushing the stock market up from the lows of sub 1500 to 2700. Now we're seeing the pumpamental upside of the Korean won. This is coming down. The red arrows are down. This is your flight capital leaving. This sells off. That will pump. We have a 2000 plus target covered in here. This will be a blow off. This target was absolutely moon through with gaps and super spikes. You can get it. SimpleFX below. Broker, counterparty risk, all exists. Make your money, keep as you're making money, taking some out. There will be counterparty risk, there'll be broker fails. You could even get the short trade on and you could not get your money back. There is real risk on counterparty like never before, guys, like never before. This is a real reality. This is a real reality. Now you can be getting these updates from us back to back. By the way, a couple of things. We have awesome guys to talk you through our products. They're not salespeople that need gobby interrogation. If you think we're a scam or you don't think we're a legitimate business, keep watching. See how many years you have to watch that we're still here. We have a 14-day money back, no quibble, but we don't want the wrong kind of people in our business. We don't have to have anybody. We're lucky that way. We want to have good, new, fresh blood that is keen, motivated, and wants to build money, build wealth as much as possible, and defend wealth in reset times. We don't need people that have got a crypto mentality and think everybody's a scam. It needs to be found out. We're not interested in being found out. If you don't think we're legit, don't come. It's all good. We are having huge demand. So please book a call only if you really want to make sure you don't go down with the debt bomb. And we'll do our best to help you, but it's going to require a lot of action from you. We don't trade for you. It's non-advisory. We take you through this. themarketsniper.com. Have a sensible call. Be respectful to a respectful person who's just like you. All our people that you will interact were once purchasers of our program. That's why they're there, so that you can ask them, was it good for you? You can talk. They will show you everything. Anyway, so watch out on the comments. Only scammers. We only engage through our website, www.themarketsniper.com. There is so much more to say. The euro is losing value against the dollar again. Don't forget, we gave you this head and shoulder and said you'll have a rest after the target, but then you will continue down. Let's drop it in to that weekly time frame. There it is. This is your euro. One rally up, and then you're all the way back down. Another rally up, and you're already back down again. This is not euro strength. That is an awful rally and inverted hammer candle. It is absolutely awful. I've done a lot of coverage on Bitcoin. The most liquid, high beta alts are being killed, and then Bitcoin is also being taken down immensely. Let me say this, when the tech market truly starts adjusting properly, that the giants are adjusting like Apple and all of them, this will have a second sell-off. Yes, you've got a little hammer there. Good luck with that little hammer, by the way. But in time, if you rally up, you'll probably make a bear flag. You've had 2 bear flags actually already. It might be a rising wedge. We've called both of them to the downside correctly when everyone else was peak inflation. Bottom calling Bitcoin, bottom calling stock market, bottom calling Yes, the pattern's got a little bit smaller, the break a little bit less big. We've taken a key level of 25k. First cup gold nugget target after a 2.5 year upward setup that we said you should be long at. You are now back down, bouncing on the roof of that target you've just run. Some form of rally is indeed possible. Rising wedge, maybe a flag, maybe something else. But I would not be a buyer. When the tech market starts to sell again, when the debt issues start to play out again, when the inflation issues, all dealing with the same concept of inflation. When you have created that much money, you only have inflation, loss of buying power. So you have asset prices that inflate, and then you start to get consumer commodity costs. The commodity market is the most undervalued right now in bad currency. After all of this deflation is gone, those will be one of the best areas to be in. Gold and silver will serve you very well, but they could go down first in a shock, spill, sell-off. We are warning. We're going to do a special gold and silver update. We've recently updated our community, but those things can still play out. So here you have it, guys. Here you have it. Debt is failing. There is a real problem. There's a real problem. And you must be careful that the next project that will lead to the next proliferation, if you had 100 billion at a time and then you got 7 trillion in COVID, you may just find you get a 250 trillion release of central bank digital tokens as your new money system, and you'll have 3 months to bring in all your cash, prove that it was taxed income, and then you'll get issued your CBDCs along with your chip, with your health certificate and everything else. Watch out. They could do a mega print that will just be a super, inflate that beach ball to the Jupiter size to replace the system that has failed, and you will have a proliferation of currencies by country, and then they will still maintain brokers, not brokers, different CBDCs. You will still be hit a conversion rate if you want to go on holiday. The max extractor system is not here to make a convenient society and a slick system for you. Extraction is absolutely still the game off you. It will just be more convenient for them to surveil and inflict various forms of fiscal discipline on you on terms of what you buy, how much you buy, and maybe there's inflation. Maybe we just give everyone a 20% haircut. Okay, thanks very much for watching. Come and join us. We are trading the FX markets. We are watching the debt markets. We are 360-degree vision on all aspects that have material effects on exactly like this, the crypto markets and many other things. And we will come out wealthier, and we will do the damnedest we can to protect it in a time where most people, a polarizing event is occurring for most people. Most people will be reduced to working serfs and will resent people like us. You will need to protect, and you'll need to form community, and you will need to be safe, not only from government. Government will weaponize the peasantry against you. This is very important. There's so much reset content in here that could be discussed further. I'm sorry, go to Odyssey channel. We will also do more releases there. We've spoken quite a lot on that. This is the end of this recording that has been kind of ranty, kind of high energy, kind of lots of words. If you appreciate these contents, give us a like right now, and we will give you further updates. Hit the like button. Puppy licks. We are asking for this to help us win in the algorithm games. We are trying to give you value and give you best possible advice. Get more people watching. We can end this horrible fiat game. Save other souls from this holocaust of debt. Bye for now.